First, some background. We're going to be talking today about the green bonds market, which has grabbed headlines in the last year, the curious phenomena of a market that's tripled in each of the last 2 years, and the climate-related or climate-themed bonds market, which is much wider and much larger. The story behind this interest lies, of course, in concern about climate change amongst the general community and amongst investors. At the UN Climate Summit in September last year, some $43 trillion of asset under management were represented in statements made to the summit concerning the urgent need to address climate change and the willingness on the part of those investors, representing some half of the total global base of institutional investors, willingness to invest in climate change solutions, subject to risk and yield requirements. I mean, these are pension funds and insurance funds who have to pay our pensions out in 40 years, so they have fiduciary obligations along those lines. They're excruciatingly aware of what the International Energy Agency, the world's coordinator of petroleum reserves, says is a trajectory we are currently pursuing to a world of 6 to 7 degrees Celsius warming. This is a world that the incoming CEO of the IEA, Fatih Birol, says is a catastrophic world. John Schellenhuber, the German government's advisor on climate change, the head of the Potsdam Institute of Climate Science, is on record as saying the difference between 2 degrees warming, the G7's current target for global warming, and 4 degrees warming, which most climate scientists say we are continuing to track towards, as the IEA says, is, in one word, civilization. The stakes are extraordinarily high. We have the spectre of not just greater volatility, with much more intense typhoons, with droughts and rain in our weather conditions, but consequent desertification in many parts of the world, including parts of the world that are currently home to billions of people, like the Asian subcontinent, the South Asian subcontinent. The challenges for ensuring that we don't suffer catastrophic changes in those areas are really critical. This is not just, however, a concern about the human dimension, which should be our primary concern, but it also directly affects the investors in the north who might like to otherwise feel they might be able to escape it. According to the Institute of Actuaries, in a report published earlier last year, pension funds and insurance funds in richer countries, even if they do not have exposure to the countries of the south that are likely to be most affected by climate change, will still see their portfolios decimated in 2050 on current climate change projections. So there are simple economic reasons apart from the substantial human rights and human justice provisions to be concerned. We need a world which is able to successfully address climate change, avoid the catastrophic consequences, while still continuing to adapt to what we know is going to happen, which is warming of 2 to 2.5 degrees centigrade, the consequent rises in sea level and storm surge, and the effect on infrastructure globally. So that's kind of what we've got to deal with. The good news, and there is good news, is that the International Energy Agency says it's going to cost around $53 trillion. It's going to be an investment. This is good news because they frame it as investment in green infrastructure. And happily, the world is very good at channeling capital towards policy priority infrastructure areas. We did it in the US very successfully in the 60s. We did it in Japan in the 60s as well. We did it in Germany in the 90s, China the last 20 years, and so on and so on. The toolkits are well and truly available, currently deployed, just not deployed adequately towards green. The other bit of good news, given the challenge facing us, the enormous capital expenditure lump we have to get over to shift our planet to a low carbon and climate resilient world is that we have a world awash in capital. We have more than enough capital available and coming into our institutional investor sectors to be able to finance this solution, this transition, as long as we can construct the investments to meet the needs of capital holders, pension funds and insurance funds. And those capital holders want green, as has been indicated by the statements signed at the UN Climate Conference in September last year, and then perhaps more pertinently, as shown by the evidence of demand for green bonds, which takes us to today's presentation. The background are these groups of investors representing $88 trillion under management. The socially responsible investment sector, otherwise called SRI, represents roughly $13 trillion. That's been the initial core driver of demand for green investments and green bonds, although it's quite clear from the last year of investments in green bonds that demand has now broadened into a variety of fund managers, insurance managers, even corporate funds like Apple, Microsoft and Ford have been investing. Some $5 trillion of institutional investment is in emerging markets, EMs. Very important if we're going to see local funds dedicated to local projects over time. The green bond story, this evidence of investor demand, has seen a tripling of the market in each of the last couple of years. We've seen a notable growth in one particular sector in the last year, which is corporate earmarked bonds. These are bonds which are very similar to Development Finance Institute bonds that have characterized the sector. The use of proceeds has been the key feature of this market. That is, any bond can be used as long as the capital raised by the bond is allocated to green projects or green assets. Transparency and reporting then become critical, because if the money is going to be allocated, you want confidence it really will be allocated, and you want reporting that it stays allocated and doesn't get diverted to a coal-fired power station the second year or whatever that might be. So transparency and reporting are a key feature of this market. The bonds are generally bog standard bonds. Vanilla bonds is a technical term, would you believe? This is a bond with a very standard interest rate or interest coupon comparable to other bonds, not complicated structures. That appeals to institutional investors who are looking for bonds that they understand comparable to the other things they buy. Comparable pricing is also a feature of the market. That is, the benefits for issuers have not been distinct changes in prices. They've been other aspects such as reputation, marketing, investor diversification, stickiness, or tenor. And equally, as this market has grown and become now large and liquid, investors have not been asking premium prices for illiquidity, so we now see green bonds issued largely at the same price as other bonds. It's a 90% investment grade market. This is not a market which is like mid-cap solar equity stakes, which is scary and volatile, or has been for the last few years. Rather the reverse. It's a safe and secure market when it comes to the actual issuance that we've seen. The other growth other than corporate bonds has been municipal finance, particularly over the last year, where in Europe and in the US and even in South Africa and Johannesburg, we've seen a lot of municipalities bring bonds to both the institutional and the retail sector. That will be an area of growth. An important distinguishing feature. Bonds have a particular particular role to play, I should say, in the capital pipeline. They are primarily a refinance instrument. As you develop projects using equity or bank lending, they're the sorts of people who have the skills to be able to invest in projects, whereas the bond market tends not to have. And those projects become mature. Post-construction, they become ideal to be refinanced in the bond market. In fact, the larger and more liquid the bond market is, the refinancing bond market is, the easier it is to refinance, the more emboldened equity investors and bank lenders are to invest in new projects and to then recycle their money more quickly. You introduce greater velocity, as it's called, in equity and bank lending. It allows bank lenders and equity investors to do much more, many more projects with a limited pool of capital. Even a corporation is essentially acting as an equity investor in frontline projects, making them mature. When they're mature and valued accordingly on the balance sheet, they can issue more bonds to finance more new projects. So this concept of refinance is absolutely integral to the bond market and the green bonds market. For that reason, we have seen in this market a significant proportion of bonds which are for refinancing of existing assets and projects, which we welcome. Whether that be a rail bond, which is refinancing a portfolio of assets, or whether it be MIT's property bond, which was refinancing a bond that was issued a few years ago to build 2 green buildings on the MIT campus. Important feature. I'm now going to hand you over to Tess to take you through a bit more detail.
So what type of projects and assets are these green bonds financing? We took a look at all the labelled green bonds that have been issued to date and broke down the use of proceeds of these bonds and found that the majority of proceeds are actually going towards energy, renewable energy. This is quite unsurprising because it's an area that investors will feel both comfortable with, and even the early corporate green bonds from the likes of EDF were for renewable energy. But since then, we've seen bonds come from GDF Suez, Iberdrola, Terraform earlier this year, Power Operating, who've just come out with a further second bond, and Tenancy, who did a big $1 billion euro bond just a couple months ago. But although there is a lot in renewable energy, there's also a shift in the past year towards more financing of low carbon buildings in the building and industry sector. These are coming from a large portion are renewable are municipalities in the US who are like Arizona State, and Shaw just mentioned MIT, and other universities that are refinancing buildings. But there's also entities like Stockland out of Australia and municipalities in Europe that have been active in this area using green bond proceeds for these types of projects. And Development Bank of Japan, which also came out with a labelled green bond to finance low carbon buildings. Another area of interest is transport, which is also another growing section. Transport for London issued a bond earlier this year for its underground, overground, bus and bicycle projects, which was really interesting and the first pure play to come out with a bond, pure play in the sense of all of its entities' revenues coming from that one type of project. So that was an interesting development, as well as, you know, it adds to Ontario and Export Bank of India, who have also brought out bonds for transport.
A key feature of this market, another key feature, a few key features, has been the development in the past year of the idea of independent reviews. The very first bond that was issued by the European Investment Bank in this thematic universe, Climate Awareness Bond, was effectively self-certified, self-audited. The EIB has now moved to having KPMG do an audit of their bond. That's that reddish bit of pizza on this pie chart. The other market, the bulk of the market, has been influenced by the World Bank's decision with their first green bond in 2008 to get an independent review of the framework for decisions about projects that would be included. That was done by Cicero, University of Oslo. That has since spawned many copies. Particularly in the corporate market, we've seen the growth of other players such as Vigeo and DNVGL, and then more recently, climate bond certification, which I will come to a little later. The key achievement has been to get issuers in this market to seek verification of green credentials from a third party or to reference a third-party standard, such as the US Green Building Council's LEED standard, to determine the green quality. Roughly 90% of all bonds outstanding fall into that category, with a very few municipal bonds in the US in sections like water that don't so far. This is an outstanding achievement of the market. This has been enshrined in the voluntary guidelines of the green bond principles, and is something we're looking to pursue more robustly the certification scheme. The evidence of continuing investor demand can be seen in further investor statements over the last 6 months and some notable pledges. In the Climate Bonds Initiative, one group of investors representing 2.8 trillion has come out and talked about their commitment to growing the green bonds market and their willingness to work with groups like the Climate Bonds Initiative to do so. The Norwegian Sovereign Wealth Fund, Norges Bank, has indicated it now has a green bond commitment within its portfolio. A number of insurers have indicated that they are wanting to grow their climate smart investments by tenfold by 2020. That insurance block represents 20 trillion globally of assets. They are now actively seeking opportunities to fulfill that mandate. A number of funds now have $1 billion or thereabouts green bond portfolios, such as Deutsche Bank Treasury, Actium, Barclays Treasury, KfW. Zurich actually has 2 of them. And now we've seen the growth of specialist green bond funds mandates. SEB Asset Management, State Street Global has 2. Narova launched one recently. Finally, the most important indicator of continuing investor demand has been that oversubscription remains usual. A few weeks ago, ABN AMRO, for example, received €1 billion of orders for its 350 million issue, which they then upsized to 500 million. Just last week, Goldwing issued China's first green bond, and they received $1.4 billion of orders for a $300 million bond. This is a common story in this market. The demand is there, folks. It's time to get supply out the door. Other developments of note. In Germany, we've seen the first green fund brief, covered bond, from Berlin Hypo. We expect to see more this coming year. We've also seen this interesting development of sustainability and social bonds. Some of these have been issued by bodies like NRW State that felt they didn't have enough green assets to justify the size of the bond, so they mixed investments or expenditure programs around small and medium-sized enterprises with equivalents in green assets and called it a social bond, which still was able to be successfully placed for investors. This is an interesting development around what I'd call purpose and capital, the marrying of the achievement of returns commensurate with the needs of pension funds and institutional investors, and active statements of the achievement around social purpose. More recently, we've seen the development of the certification scheme that I've mentioned before under the Climate Bond Standard. We've now seen 3 banks issue bonds successfully with significant oversubscription: National Australia Bank, Australia New Zealand Bank, and ABN AMRO in the Netherlands. Green bond indices have all appeared in the last year from 4 different players. We've seen a version 2 of the green bond principle significantly improved on version 1. And more recently, the Climate Bonds Initiative has launched an advisory services program to support people considering coming to market with issuance and needing some support around that activity. But there's more. In the bigger scheme, the important thing from our perspective is that capital flows to climate-related investments. We don't really care, to be honest, whether they're labelled green or climate or purple or violet. What counts is that capital flows. In looking globally at bonds that are easily identifiable that could be used as is in the portfolios of institutional investors around the world for climate exposure, we find 597.7, nearly $600 billion of bonds that are available for investments, most of which are not actually labelled green. Only 66 billion or so are currently labelled green. Of course, the green bond labelling is extraordinarily useful to make it easier for investors who don't have the time to rummage through the global bond market looking for climate-themed bonds to find them. It's a discovery tool. It reduces transaction costs. It reduces effort. A bit like the iPhone's interface effect in smartphone sale, we expect and hope that the green bonds labelling scheme will explode investor participation in this market beyond the relatively modest levels. Of course, we already have project bonds in solar and wind. They're not necessarily always part of the green bond market because they're not following some basic rules around transparency and reporting. This will be simple and easy to solve in the coming year. What we'd like to do, of course, is to convert that whole $600 billion universe quickly into a green bond universe. Why? Because that would give us the large and liquid market that will make refinancing very easy for equity developers, bank lenders, and others, which will allow further velocity to be delivered to the front end of the wave of change that we need to see in a rapid transition to a low carbon and climate resilient economy. Our ambition, $1 trillion a year by 2020. That's a pretty big ambition, we will admit that. But if you look at the scale of capital that the International Energy Agency tells us needs to be deployed every year by 2020, this is really the minimum that we need to get to be sure that we are successfully beginning to tackle the vast challenge of climate change. Now, a little bit of detail about the kinds of themes involved in this particular market. Tess.
So our approach to providing a snapshot of the climate-aligned universe was to look across the real economy and the sectors that fit into the climate bonds taxonomy, which is available on our website. And these cover more than just renewable energy. It's also low-carbon buildings. It's also looking at what type of transport we need to be doing in the future, low-emission vehicles, electric vehicles, rail, etc. And also to agriculture and forestry, sustainable forests, and then waste and pollution, and also sustainable water, and then also those sectors that cover all of those, so those CFIs, municipalities that are actually financing a little bit of everything. So the way in which we approach the research is that we screened and did a deep dive of 1,400 issuers and found those that have over 95% of their revenues from climate-aligned assets, and then pulled the bonds that are associated with those issuers that have been issued since the 1st of January 2005 and are still outstanding on the 10th of June 2015. And this created a pool of $597.7 billion of bonds outstanding right now that fit into these mitigation and adaptation sectors. So if we look at the breakdown of what the composition of those sectors are, so there is a big chunk of it in transport, and in particular this is accounted for by rail. If we look at the China National Railway, Eurofema, Network Rail, etc., these are big issuers of bonds, and they're all fitting into what we define as a low carbon, climate aligned sector. Another part of it is obviously renewable energy. That's the second biggest. Part of this is hydropower, as well as solar, wind, and geothermal. A note to everyone on the energy is that we include nuclear energy in our calculations. This is because we consider it as low carbon, even though it will be controversial for some investors, and we do acknowledge that. Buildings and industry is a growing section of the universe, as I mentioned before, mostly because of the labelled green bond universe and the growth of that, and looking at energy efficient buildings. Waste and pollution, again, has benefited from the growth of the label Green Universe, with Paprec as French issuer and Shanks PLC both issuing waste-labelled green bonds this year. In agriculture and forestry, the sustainable forest is the biggest, 82% of that part of the theme, but there's also sustainable paper companies which again use certified forest feedstock. Water is a relatively small part of the universe, but growing, and again, it's sustainable water, looking at widening stormwater tunnels or energy efficiency in wastewater projects and the types of assets that we're seeing in that sector. The majority of climate-aligned bonds are investment grade, so almost 90% are investment grade, which means that there's actually, it's not a small niche area. It's large investment grade bonds. The biggest proportion of them have over 10-year tenors. So this longer dated maturities reflects the long dated rail bonds in particular. But within the universe, there is a range, even within the investment grade, of what's available for investors. So it's a large and liquid universe that's ready to be invested in right now. Looking further at the opportunities for investors within the universe, there are project bonds, as Sean mentioned earlier. We saw Hallett Hill project bonds come out in the private placement market in the US this year, which were especially interesting, backed by wind projects in Adelaide in Australia. And they actually had a second review from DMVGL, so similar to what we would see in the labelled green bond market, which was an exciting development. And we sized that there are 13.9 billion of those types of project bonds that are backed by green projects outstanding right now. We also break it down into the mainstream index, filtered index, which is where we've taken the full climate-aligned universe and put additional filters on to see what mainstream indices would actually be, what would be eligible for mainstream indices. The reason we do that is because the majority of investment managers will have a mainstream indexes as part of their mandates, whether it be actively trying to beat those indexes or whether they are tracking those indices. So we wanted to give a flavour of what is actually fitting into mainstream indices. So the filters we put on were investment grade, so BBB or above. They had a minimum size of 200 million and mainstream currencies. So as you can see from the table there, there is a range within those investment grades that you, across all the themes. The only noticeable theme that hasn't been have any opportunities in is agriculture and forestry, and that's because of the size of the types of bonds coming out of that sector. Outside of this mainstream index, there are significant opportunities, for those investors that can invest in the Chinese yuan, that can invest in the Thai baht, but it's really to give a flavour that this is not, as I mentioned before, a niche thing but just for those that can go outside of mainstream indexes, that there is a lot of opportunity and diversity within.
Okay, thank you, Tess. I said earlier, I just mentioned the Climate Bond Standard Definition and Certification Scheme, which is being introduced into the industry as a more commoditised approach to how we determine the green credentials. Version 2 of the Climate Bond Standard is currently out for public consultation. Please do go to our website and have a look. It incorporates the reporting and transparency requirements, or guidelines, I should say, of the Green Bond Principles, and makes them mandatory, and addresses a range of green criteria. This particular project uses a model which brings global expert committees together in academia or in specialist organisations to look at what are criteria for water projects, for hydropower, for transport, low carbon transport and so on, what the criteria should be. We also bring industry working groups, which are investors, banks and other parties in the financial sector, to critique the draft criteria, and it's through that to and fro between the academic experts and the invest groups that we come up with criteria that are bond market friendly, relatively bond market friendly. It's an important part of the work we're trying to do. Through that process, we are and expect to continue to be able to keep the cost of verification of green credentials low. The reduced cost of transaction is a significant issue in making sure this market is highly scalable. A modular standards-based approach will support that. Standards will allow investors to more readily compare apples of apples in different markets when it comes to different kinds of bonds, and then to be able to trade on the secondary market very quickly at the kind of instant decision-making required by bond traders. So this is what we think is the way forward. Overseeing the work of the expert committees is a climate science framework. The chair of that committee is Potsdam Institute of Climate Science CEO John Schillenhuber, and there are other organisations becoming involved. That work is beginning. We will see announcements about that work in the lead up to the Paris Climate Change Conference. A key feature of this particular scheme is that the standards work is done as a public good, financed by foundations or grants, avoiding some of the conflict of interest that can occur with rating schemes, where the organisation doing the rating is also financed by the issuer. Here, the independent verifiers, accountancy firms, audit firms like EY and KPMG, specialist reviewers like DNV or Bureau Veritas, are organisations that are simply assuring against the public standard that both keeps the cost down and reduces the potential for conflict of interest. Overseeing the climate bond standard is a board that represents $34 trillion US of assets under management, and a couple of NGOs, the Nature Resources Defence Council and CDP, the former Carbon Disclosure Project. The Treasurer of California is in fact on this board, representing the state treasury investors market in the US. This is an attempt, so far working, to create a fair trade-like brand within the green bonds universe to provide instant comfort for investors about the green credentials of a bond, to increase participation as a result. The kinds of assets that can currently be developed are in the clean energy, buildings and transport sector, with a bunch of other criteria about to be released over the next few months. Certification is a simple three-step process of identifying assets, getting an independent review, and then tracking and reporting. As I indicated earlier, so important to this green bonds market and confidence on the part of investors of where the money's going. Finally, prescriptions for the future. The advice we give governments around the world and people looking to grow green bond markets is we need more demonstration issuance. Blue chip, very solid investment grade issuers that can do bonds which show other parties in the economy how to do this. On the back of that, we then have the opportunity to provide education for prospective issuers and for investors. We also need a pipeline of green projects. The truth is we have more than enough demand now amongst investors to buy green bonds. We simply lack green bonds. We need to get governments and other organisations getting their act together by planning green projects, bringing them to market and getting them financed in this curious period in history where interest rates are at an all-time low globally, when investors in Europe have to pay the German government to look after their money with negative interest rates and bonds. We now need to capitalise that moment by delivering investments to provide those investors with some yield, a few percentage points to contribute to paying off our pensions in 20 and 30 years' time, and financing a global reindustrialization, a global shift to green infrastructure. One of the things we need to do in emerging markets is aggregation of small-scale projects. That will mean green securitization and various themes along those lines. Underpinning all of this will be a strong emphasis, particularly on the part of development banks, but also on the part of government, of various risk bridging tools, such as credit enhancements, such as regulatory support, such as tax incentives. Finally, we do need to be aware of the need to rebias our financial regulatory systems. For example, under Basel III, we have a push towards short-term debt on the part of bank holdings at exactly the same time when we need to see more long-term debt to finance long-term clean energy infrastructure. We need to be thinking of our financial regulations in the context of supporting, not working against, the incredibly important transition to a low-carbon economy that we face. In fact, it may be that we should be looking at negative capital charges for green investments when it comes to balance sheet requirements for banks and insurance funds. The Chinese central bank is exploring doing this as we speak. Other banks will follow. What we can expect to see next. This year will mark a changing of the narrative of the international climate discussion from one that's been a burden approach of taxation and carbon pricing, however important, not exactly proving to be as stimulating and as exciting as we would have hoped it to be, to one where we begin to look as well at the green infrastructure opportunities. Remember, we said earlier, the International Energy Agency characterizes most of what we have to do as a green infrastructure challenge. That leads us to a whole different toolkit. It also leads us to an understanding that infrastructure, or rather to the story of infrastructure as an economic multiplier activity, as an activity that we understand inherently leads to improvement in the economic situation of countries. That will require a close partnership between institutional investors, our pension funds, our insurance funds, our sovereign wealth funds, and governments to deliver a pipeline of deals going forward. It will require a shifting of the role of development banks to leveraging private capital rather than direct lending as that pipeline comes on stream. You will also see next the growth of new markets. China is about to take off like a rocket. As I mentioned earlier, the green bond guidelines are soon to be released by the central bank. In India, we have seen the government aggressively recommending green bonds amongst state banks as a way of providing initial liquidity in the market. Green bond market development committees have been set up in Mexico, in Brazil, in Turkey. There'll be more of these to grow local demand and local issuance. We will see the adaptation of US securitization, appearing of solar rooftop, for example, with Solar City and Solar Star, into projects in other countries like India and Africa. And we expect to see the green muni market, currently mainly in Europe and the US, go global this year, with issuance from emerging markets and the growth of a new subclass, which is a global green city bond market. Further moves for market integrity will be important to ensure that we are all able to maintain confidence that our money, the money we have given, our pension funds and insurance funds, goes to genuinely green projects. Standards and certification will be part of that. But we must always keep an eye on the idea, the issue of transaction costs. If this market is to take off, we need to find ways to deliver confidence with low cost. That is the tension for the coming year. Watch this space. Thank you very much for joining us today. You'll find more information on our website. Please do subscribe to market updates. I'm now going to ask for questions before we wrap up today's seminar. And I'm going to turn to an in-studio guest we have with us today. Johan Krimphoff from WWF has been listening to the presentation. Tell us, any questions as a result of today's presentation, Johan?
Thank you, Sean, for this great presentation. I have a question related to the segment of what you call the labeled bonds. There has been a lot of discussion about what actually is green and what is not, and what type of criteria issuers and investors use to decide whether they actually think a bond is green or not. The climate bonds standardization program, standards program, obviously seeks to provide an answer to that question. How do you see this question and this discussion develop over the next 12 months, next year, in 1 year's time, in 2016? Where will we be at with that question?
One of the things we're trying to do is to explain to people the extent of the change required to shift our economies to green. This isn't a matter of building just solar farms, as big as that particular stream of work needs to be. It's not just building wind farms. It's not just greening our property, although we do need to shift our cities, our built environments to low carbon very, very quickly. And it's crazy we're not doing it because the paybacks can be 3 years, maximum 5 years for most buildings around. But it's also a rethinking our industrial economy. It's building in circular economy, recycling, resource efficiency. It's reducing the low carbon footprint or the carbon footprint of most of our industry sectors and phasing some out. We need to get out of high greenhouse gas fertilizers and replace that with other options like biochar, for example, let alone the whole agricultural story. So one of the things we do see with this discussion about the potential investment is, as a corollary impact, a greater understanding of how much there is to do, but how doable it is. You know, it's amazing when you start looking at each of these areas, how much can be designed with the support of government, with various regulatory and other support measures, as an investable proposition. Now, I think this is really important because the truth is, with the kind of climate volatility we now know we're going to have over the next 20 years, the relatively short term, we're going to need to ensure that our economies are robust and resilient to deal with the constant shocks of intense storms, of droughts, of rainfall, floods, let alone storm surges. We can expect Manhattan to be 2 meters underwater, 4 meters underwater, again, on a more regular basis than we've seen in the past. These sort of things require allocation of public sector capital to resilience, which gives us an even more urgent need to shift everything we can that can be financed by the private sector into the investable proposition market. We've got to be really creative about public-private partnerships here. Now, I think that the larger climate theme market, which is potentially even much larger than we have now, we've just looked at the pure play, at the bonds which are 95% or more green. We can go to Siemens, for example, who has a large wind energy investment. They could be issuing corporate bonds against that wind energy division, which is 25% of business, and they would be green. So there's a much bigger universe beyond this, potentially. This is really important. We can grow this market quickly. We can educate investors, governments, issuers, and ordinary citizens like you and I about what is green. And through that process, we can create this large and liquid green bond market, which will do two things. One thing is we pull through equity investment and bank lending by making it much easier for those folks to do what they need to do with their expertise and then quickly refinance. Velocity at the front end, like the froth beginning of a wave. But also, we have to pull through governments by showing very clearly that there is no shortage of investor demand. And the more we explain it to investors, the more their portfolios grow. We want to embolden governments to be much more ambitious, which they absolutely need to be if we're to have any chance of getting out of the climate change hole that we're in. So that's what I think we're going to do, be able to do, by doing this larger analysis of the market and through the process of educating investors, relabeling, repackaging, bringing in those investors' understanding of the market. Does that answer your question?
Yes, thank you.
Do we have any other questions on the line, Kate? Okay, folks. In the absence of other questions, we're just near our last time. Please do type into the Q&A box if you've got any that you would like to have answered. We will be running another webinar like this in 36 hours' time. We're also, for those of you that are lucky enough to be in London in the summer weather, running an event tomorrow morning, which is a similar launch. We will expect to be running in-person events, which are launches of this over the next couple of months in Sao Paulo, in Paris, in Shanghai, in Beijing, and there may be others as well. We're very keen to provide people the opportunity to find out more and to ask questions and grill and interrogate us as much as possible. This is part of a continuing process. This report will come out again next year as well. Please keep an eye on what we think is perhaps the most exciting, positive development in terms of positive stories around climate change. We need to reconceive the challenge we have around climate as a positive economic stimulus, green infrastructure activity. There are challenges, there will be burdens, but with the kind of investments that need to be made, as the International Energy Agency says, we will see economic growth, economic multiplier, and an antidote to the challenges of austerity we've experienced recently. We can both restart our economies while addressing the enormous spectre of climate change. That's the opportunity we have in front of us. Thank you for joining us today. Please do send any questions you have to info@climatebonds.net and go to our website for more information. That email address again, info@climatebonds.net. Thanks again, everyone.